Good morning, everyone, and welcome to the Hedgeye Morning Macro Call for Friday, February 13th, 2015. Before I hand the call over to Keith, I'll briefly touch on our asset allocation changes from yesterday. So we're reduced to 45% cash from 47% yesterday. We increased U.S. equity exposure to 9% from 8% yesterday. International equity exposure increased to 7% from 6%. Commodity exposure held flat at 0%. FX increased to 8% from 7% yesterday, and reduced our fixed income exposure to 31% from 32%. If you have questions, you can email them to qa@hedgeye.com or go ahead and send them along in the box next to the YouTube feed. With that, take it away, Keith.
Thanks, Ben, and good morning. This is the morning show, so the first thing I'm going to do is go through the top three things right after I just give you the update on that asset allocation model. For those of you that don't know, we do it differently, much like everything else here at Hedgeye. And again, we look at asset allocation on a net basis. So this does come from my hedge fund trainings, which is, of course, having longs and shorts. And the max net position we can have to an asset class is a third of our capital. So again, fixed income is 31%. Currently with U.S. equities up, and again, we don't like every U.S. equity. We like U.S. consumption stocks, we like early cycle housing stocks, and we don't like banks and energy stocks. So that's just the asset allocation. Now, on today's top three things, and again, I try to boil down the top three things that are moving macro markets, and again, this is a dynamic and nonlinear world where these things change, but again, I try to focus the mind on those top three things, so let's just do that. Today's top three things in my notebook are number one, the US dollar, number two, oil, and number three, all of Europe. So let's just first get into the US dollar. It's an interesting but maybe not surprising setup if you look at what happened yesterday. Number one, retail sales slowed 0.8%, after slowing, by the way, in the month prior. So again, you did not get these huge retail sales numbers associated with the down gas price thesis. By the way, if you went to fill up your car, you didn't go fill it up twice. So that is reported nominally as lower retail sales. So again, that was point number one. Point number two is jobless claims shot over 304. And point number three, the dollar went down. So again, what happened yesterday was largely driven by a down dollar move. The best performing sectors in the S&P 500 on the day were, of course, highly correlated to the inverse of that, which is down dollars. So again, you had up energy stocks, up basic material stocks, and again, actually the consumer discretionary stocks underperformed on the day. Now that's point number one. That's not a trend, that's a counter trend move. So again, you have to trade around that, you have to accept it. It is what it is, it's driving markets big time. Now point number two is oil. If you look at what's happened in oil, it was up 5% on that. So again, a down almost 1% move in the US dollar index equated to an almost up 5% move in oil. So again, the correlation beta is what we call it to that, is extremely high. So again, watch out for that. And you have to ask yourself at this point, with the price of oil in particular, is the up 1% fall through today the new trend, or is the down 33% that it's been down in the last 3 months the trend? So again, we have to contextualize that with what we call the immediate term risk range, which is not the trend. The trend is intermediate term, which is called 3 months or more. But on the immediate term risk range, what's interesting about oil at this point is that the range is narrowing. So that says really three big things. Number one, a narrowing range leads to lower volatility. So if you look at something like OVX or the oil volatility index, that looks like it may have put in a short-term top. The second point is that we're getting lower highs in oil in the risk range. And the third point, we're also getting, we're getting higher lows in oil and we're getting lower highs. So again, lower highs is bad and higher lows is good. And declining volatility is net not horrible. So again, that makes for a very confusing setup. And again, if the dollar holds in bases again, oil's going to go down. So again, hold yourself within the risk range is what I'd say about that. Trade the risk range, manage the risk range, use the risk range to trade equities that are associated with that, which is again, dollar versus oil. And the current risk range that I have in my notebook for the price of oil, and again, I'm looking at WTI, is 47.42 to 53.45. Now, the third big thing that's going on this morning is, of course, Europe. Europe has been saved, naturally, of course, always. They needed $1 trillion to do what? I mean, German economic data accelerated in the fourth quarter, evidently. So mainstream media is going to run with that. That was the only good data point out of Europe this morning, so they'll focus 100% on that. It was a very good data point. We've said it a whole bunch of times. I'll say it again. If you had to be long and short things in Europe, you'd be long the good balance sheets and the only economy, really, that has the best economic data, which is Germany. company and you'd be short the crap. And I said this on Fox the other day. It's fine for me to say it here. They're definitely not going to fire me here. But the reality is that that's what I said, and I'd say it again. So again, if you look at the economic data away from Germany, again, a 1.6% year-over-year GDP number, it's not great. It's just not terrible. If you look at the rest, I mean, Italy had a negative GDP number. France had a flat year-over-year number. If you start to look at the January numbers, because again, these are European data points for the fourth quarter that I just addressed, the current data points, the January numbers on deflation, which is different than growth. When you think about macro, again, if you want to do it right, think about growth and inflation and try to remain sober at the same time. These things bounce around. They're not the same thing. On the deflation reports this morning, you had very deflationary numbers for the month of January. You had Swiss PPI drop 2.7% year over year. PPI is producer prices. And then, of course, you had Spanish CPI, which is consumer prices, that went negative year over year on the order of 1.3%. So they have deflation. That has not changed. Arresting the deflation has been next to impossible. I do not think that Draghi will be able to do that on an ongoing basis. And again, there will be a different thing that's called the market in Europe versus the economy. Sound familiar? Remember QE in 2011 in this country? The market ended up going up in certain components. Utilities were up a bunch, financials were down a bunch that year, but the economy was terrible. So again, the economy versus markets. This is a very important thing to delineate when you're trying to delineate things, because again, it's not a linear path between the two, which makes this very difficult. Again, it's not an easy game to play. Anybody who absolutely nailed yesterday's move on, hey, I wanted the retail sales number to be bad and then everything else to go up, I mean, that would have been a nice call to make. But again, these are very difficult calls to make when you think about those top three things altogether. Now, that's what I have to say about that. If you look at today's risk ranges, and I'll just spend the next 6 or 7 minutes just going through what the risk ranges are around the world and what the trend implications are of those risk ranges. And again, you can go bullish within the range but stay bearish within the trend. Again, that's a multi-duration look at something. Multi-factor, multi-duration, that is how we roll, and we will not apologize for sounding less than dumb about it. Looking at the risk range in the S&P 500, 2054 to 2094. So it's an immediate term range of 40 points that's signaling higher lows and higher highs. That's bullish. So again, that's why we're not short the S&P 500. You could actually be long the S&P 500. We'd rather be long the Russell. The Russell looks better than the S&P 500. We've gone through it multiple times, but just to remind you, many more people are short the Russell than they are the S&P 500, and we like to buy what people are short. Volatility, looking at the risk range on that. Now we're down at 15.14 support for the VIX on the front month, and resistance is 19.89. So again, as you get closer to 15.14 on the VIX, and as you get closer to 2094 in the S&P, you sell some of the things that you bought when the S&P was lower and the VIX was higher. This is not that complicated. If you were buying things that we liked at the end of January, like housing, for example, I mean, you'd sell some of that. Look at the chart of housing. For the year-to-date, ITB is up 6.5%. The S&P 500 is up 1.5%. And again, that is what it is. It's a lot of alpha. You want to book some at the top end of the range. You want to sell some at the low end of the range. And then you want to rinse and repeat. Just like I tell my children, you got to rinse and repeat. You have to brush those teeth every single night until you get to be my age, when you have fake teeth. Some of these hockey teeth, I got to brush those too. Rinse and repeat. That is part of the process. Has absolutely nothing to do with macro, and I don't know why I said that. Looking at the rest of what's going on in the world last night, Asia does not cease to exist. Again, think about what went on in Asia last night. It's an opportunity. Because again, the yen has had some problems here, because again, the yen, problems for the Nikkei, because the yen, of course, doesn't go down when the dollar goes down. So when the yen goes up, you get buying opportunities in the Nikkei. Now the Nikkei was down a little bit overnight. I wrote this in this morning's early look strategy note. I write that every day. I shouldn't say I write it every single day. Some days the other guys write it, but again, I try to write it as many times as I can. But what I actually wrote was, in rank order from this price in global equity markets, I would number one by the Nikkei, rank order like in terms of preference from here. Nikkei would be number one actually. DAX would be number two, and the Russell 2000 would be number three. On pullbacks. So again, we're going to get a pullback in the Nikkei because the dollar was weak and the yen went up. So understand that correlation trade. That's to get the Nikkei right, literally all you have to do is get the yen right, and to get the yen right, you have to get the dollar right. It's not that complicated. Even a mucker can do it. And again, that's with an M, a capital M, not an F, folks, not an F. Not an F. And I don't like calling people folks. China, 1% up move. It's now down 1% for the year to date. What you do with that is your prerogative. I have no idea what to do with it, so we're not making a call on it. Kospi up a little bit. Australia was where the real juice was last night. So again, follow the bouncing ball. Retail sales, jobless claims miss, dollar goes down, commodities go up 2 times what the S&P went up. The commodities index, CRB index, was up 1.9% yesterday. And Australia, which is a commodity-oriented index, was up 2.3%. So again, it's all one gigantic macro trade that was correlating to the dollar. And again, I've said that multiple times. I'm just giving you different components to reflect upon that. Europe, I've already said my piece. Russia's got a ton of pin action on that. Again, Australia goes up over 2%. Russia, that's up over 3%. Of course you're going to buy Russia on that. Again, up oil, up Russia. But is that a trade or a trend? So the risk range, it really matters in Russia. The Russian Trading System Index, the current risk range is 738 to 895. 738. You'll note that it's trading pretty close to 895. So today might be, and again I'll signal it if I get the signal, it might be a short selling opportunity towards the Russians. Again, I like that. We've made this call multiple times in the last 6 months, but we've been waiting for the overbought signal in Russia, and we are certainly getting closer to that. In Russian terms, if you want to short Russia, short it in terms of Russia. That's what I say. Looking at oil, I already gave you the risk range, but just to remind you again, 47.42 is support, 53.45 is resistance. Gold does not look good. Why would gold not look good? Well, there's a couple of reasons. Interest rates haven't gone down for really the last week. That's number one. And number two, if the dollar holds here, that's not good for gold either. So I have downside risks in the immediate term range for gold at 1204. So we took that off the investing ideas list. I don't like the looks of that. Certainly not going to sit around and ride that. I have no problem coming back to that. And it would be in gold terms. Gold terms. If you like gold, you buy it in gold terms. I think people know what I'm talking about when I talk about those terms. 10-year bond yield, downside again to the risk range. This range is going to blow your mind, particularly if you're bullish on bonds. The immediate term downside in the risk range for the 10-year bond yield is 1.65%. So you can see that chart. It bounced big time off the lows. Again, you're coming off pretty near the all-time lows. So if you nailed the all-time lows, which was into the end of January, which we did, you just got nailed in February, which I did. So the biggest mistake that I've had in February, not only staying short the banks, is staying with my long bond position. Now, my biggest mistake can become my biggest victory if I stay with it. And again, if we're going back to 165 on the 10-year, you definitely want to be accumulating or reaccumulating or starting to get into, God forbid you haven't owned the long bond for the last 14 months. But again, this is where you do it. Now, we do have a catalyst, which is next week, which is CPI and PPI in the U.S. will be reported to the downside. That will bring back the doves. So again, a lot of people are currently trying to short bonds because they think the employment situation is going to drive the Fed to do ABC, which is tighter. Now, I think that the deflation data comes into play, again, into that dialogue, and that's your catalyst next week. So if you're looking for a catalyst for TLT, EDV, yeah, you know me, all these different things that we've been talking about for a long period of time. I don't want to repeat myself entirely. You know what I mean by that. Foreign currencies, the risk range on the yen, if you're looking at to trade the Nikkei, just to wrap things up, the downside in the risk range is 118.25. The upside is 120.45, and I am talking versus the US dollar. Economic data points, I already summarized it. It's mostly European this morning. And again, it's pretty light on U.S. I think you get consumer confidence on the Michigan reading a little later on this morning. But away from that, it's pretty quiet. People in America seem to be taking a lot of European-type vacations these days. I didn't see a lot of people on the Merritt, which is where I drive in from to begin with. If it snows, people don't go to work. People don't go to work anyway, it seems.
It's Friday.
It's Friday. But I'm working.
All right, thanks, Keith. We have a good list of questions here in the queue. Is there anything you can think of, or maybe I should rephrase this? What are a few things that you can think of that have a chance of triggering a meaningful correction greater than 7% in the S&P 500 this year? It hasn't happened in approximately 4 years.
I think you've already seen the preview to that. What the market really gets nervous about is deflation. So we've seen multiple snapshots of this. It's called September the 28th when stocks peaked and the S&P 500 dropped 150 handles to the October low, which was really in the middle of October. That was very expedited. Then you ramped back up on no volume. They took them down again to the middle of December. And again, in January, they took them down straight down for pretty near the entire month on the S&P beta side. So again, you've had three separate opportunities to observe the animal in its ecosystem. And again, you can call them lions, tigers, monkeys, whatever you want to say they are, but you get a lot of people that chase momentum in this ecosystem and then they get pounded. They get just smoked. Like, you know, every time they buy at the high end of the range, they're forced to capitulate lower. I think that is predominantly driven, the lower part is driven by the absolute fear of deflation. So again, if oil were to go back to 47, I think you start to put in Bayesian speak, we would say that the probability starts to rise that we get a broader correction in the S&P 500 from here. I don't know if it's going to be 7%. I don't know if it's going to be 5%, but you would certainly see a correction like we've already seen. That's what we've seen. We've seen multiple corrections since that September peaky type level for a lot of the bubbly stocks too.
VNQ and REITs still looking good in 2015?
Yes, REITs look fantastic. I mean, the reality is that you have a pretty big opportunity that's developed in the last, since the jobs report. So since the jobs report, basically, I've been dead wrong on everything I've been right on for a while, which is rate sensitivity. So, you know, bonds have gone down, stocks that look like bonds have gone down. That includes utilities and REITs. On the jobs report itself, don't forget, utilities were down over 4% on the day, one of its biggest down days in 3 years. So again, these are the types of things, REITs in particular. I mean, the rental market is very strong, pricing is very strong, and again, until that changes, I don't see why asset allocators would give up on one of the few things in this country that can still take pricing. A lot of healthcare companies can still take pricing. I think that's partly why biotech trades so well, and so do REITs. I mean, if you can't find inflation, you're going to pay more for the inflation that's left. Okay? Let me say that again. If you can't find inflation, in other words, if you have a deflation view like I do, you're going to say, oh wow, there's some pricing power over here. I'm going to pay up for that one. People do make decisions that way. Again, people make relative and absolute decisions. So VNQ is a good way to play the long side of REITs.
Okay. I don't want you to repeat yourself here, but just maybe quick few sentences on TLT status update.
Yeah, it's the same thing. Again, TLT looks like the upside down of the 10-year bond yield. So again, TLT is going to annoy you the whole way up to 209. 209 is the first level of resistance right now for the 10-year bond yield. So again, at 209, you double, triple, quadruple, do whatever you're going to do. You decide your own sizing of positions. You have to be a big boy and a big girl, and you have to decide what you like and what you don't like. And again, I don't start with what chart's going up and what's one going down. I mean, that is, again, I have a lot of different creatures in the zoo that can help me with that type of a strategy. What I want you to do is decide from an intermediate term perspective, what do I like and what do I not like? What I don't like, I'm going to short, and what I like, I'm going to buy. But again, I'm going to buy it at the low end of the range. So for TLT, the low end of the range is most likely realized between 205 and 210 or 209, call it, for now. And again, you have a catalyst next week. Now let's see if the catalyst is right or wrong. If we're wrong on that, then we're going to be wrong. I mean, imagine you were wrong on something. I mean, I'm the only one who gets to be wrong all day long. But again, I'm alive and well on Twitter with my own company where I actually have to be accountable.
Are you still seeing the liquidity problems in the market that you talked about much of last year? I mean, that was one of our big themes in the macro deck, and then we kind of saw it play out.
Yeah, I mean, liquidity problems, to be clear, you don't see until markets go down.
Yeah.
When markets are going up, there's still illiquidity is still a problem, but you don't have to pay the piper on that.
Yeah.
You know, yesterday I was speaking at the Boston Securities Analyst Conference, and the discussion was about asset allocation and liquidity. So when you're allocating assets at this stage, late cycle in the employment cycle in the US, you want to be getting long liquidity. You don't want to be stuck with illiquidity. So again, a big mistake I've made, every hedge fund I've seen do well and then not do well makes, is that they get into illiquid securities or investments that they can't get out of, and they start to go the wrong way. Now, typically what people do is that they sell what they can, not what they should. And that's really the hallmark of illiquidity. If you want to just look at a chart on this, I don't know if the team has it, but look at a chart of junk bonds. I mean, junk bonds between really September and the January lows, or wherever people were capitulating most, that showed you the illiquidity, that is in that market. But people can't get out of that market. And people, by the way, haven't marked their portfolios to market. So again, there's a lot of illiquidity associated with debt-oriented instruments that are really based on policies to inflate, or inflation expectations. And that's where I'd be really, really careful. I'd be allocating assets into liquidity. So if I'm a bond guy, I'd be getting in, again, I've been taking my big gains, by the way, in high yield junk, and I'd be taking that and I'd be putting it into deep liquid stuff like treasuries, and I'd play this out. Again, if you believe in deflation, the liquidity problem for the energy markets, stocks and bonds, is not over. It's nowhere close to over, in fact.
Can you explain your process on increasing your equity exposure in a deflationary environment?
Yes. It's called buying low. Yeah, buying the pullbacks. I mean, if you look at our asset allocation model, again, it's not perfect, but I mean, I don't see anyone else who's got a perfect one either. Because this is tough, everyone has a different way to communicate it. But if you look at our asset allocation model on the first week of February the 3rd to be specific, we had a net long position in U.S. equities of 2%. That was the low. And then, again, U.S. equities were down for the year to date, and significantly so on a relative basis versus bonds at that point. So we started to allocate assets to the things that were lower. That's it. We live in an environment, and I'm very well aware of it, that a lot of people have very much the opposite strategy that I have. They chase momentum. I fade it. So again, maybe it makes us unfriendly bedfellows. And by the way, I don't want to go to bed with these monkeys. And they don't want me to be anywhere around them either. It's just a different strategy. But again, understand that momentum strategies are largely populated, born, and flourishing at bubble tops. They were the same in 2000 as 2007 as 2014. The people that you see on Twitter in 2014 may or may not have blown up in those other 2 years. But again, it's a strategy, momentum chasing, buy high in hopes of selling higher. And we just need to be aware of that. That's a very relevant strategy that works during certain market periods, and it doesn't work in a very meaningful way in others.
Okay, question here on your risk ranges. If your risk ranges tighten or start to tighten, do you put more weight on blown out sentiment in a market like CFTC positioning for capitulation risk that would take out your level?
If the risk range is tighter or wider?
Yeah, if it gets tighter.
Yeah, if the risk range is tighter.
Say your risk ranges are tightening, but you have a market where sentiment is blown out.
Like sentiment is bullish or bearish?
Bullish.
It's bullish and it's tightening?
Yeah.
Yeah, then I'd go with consensus. Then that's the most likely point where the risk range is narrow that the bull can be right. Because the bull, by the way, has been wearing it the whole way down. He's just waiting to recoup some losses, to be clear. A risk range that was widening is called a leading indicator for rising volatility. When volatility rises, the momentum monkey, again, sorry to call you that, that's what I think it is, you get your face ripped off. Once volatility starts to go down at a lesser rate, or the risk range starts to narrow, then the pain of the momentum guy starts to alleviate in the very short term. And again, these things change on a nonlinear basis. That's the point. That's why you have to remodel. I literally remodel it and refresh it every 90 minutes of live market trading, because I have no business telling you or anyone else for that matter what the risk range should do. The market's going to tell me, I will accept it for what it is, and I will behave accordingly.
Okay, last question here. Sounds like you believe we may get a continued trend higher. Is this based on the potential for the United States slipping back into quad 1 momentarily for Q1?
Yeah, they could. I mean, the quad 1, to be for those of you that don't know, our quad framework, I think it's slide 29 in the deck if you want to put it up, team. 4 quadrants we have, and again, the first quadrant is when you have growth accelerating, consumption growth specifically, as inflation's falling. So again, this is a call we made in 2013. We got bullish on U.S. growth stocks, specifically high multiple growth stocks and consumer stocks. Again, you could go there for the first quarter this year because on a year-over-year basis, and we model the U.S. economy like a company, on a year-over-year basis, the same-store sales or comp comparative period is very easy. Don't forget that remember last year in the first quarter, everyone was shocked that GDP surprised on the downside other than us. I shouldn't say everyone. A lot of people are just permanently bearish, obviously, but it's an easy comp. So that's why I don't want to own everything in the S&P 500. I want to own the parts of the S&P 500 that capitalize on that consumption growth accelerating. That's why we're bullish on restaurants, regional casinos, housing stocks, pick your consumer stock, restoration hardware, one we've been pretty vocal on for a long time. So again, I want to pull out the parts of the market that fit that, and I want to get rid of the other parts. And once we get into the second quarter, by the way, we're out of the first quadrant, it's a lot less easy because the comp in the second quarter, the year-over-year comparison gets more difficult actually on a significant basis.
All right, thanks. Good stuff. We'll wrap it up there. Thanks everyone for tuning in, and we'll catch you back here on Monday, same time. Have a good weekend.